Hello, everyone. Thank you so much for coming to class today. This is just a reminder that this seminar is being presented for educational purposes and is not intended to take the place of a specific financial advice. What is right for one individual will not be appropriate for everyone, and you are encouraged to seek professional advice in the areas of investing in retirement plans, insurance, taxes, banking, and real estate planting as appropriate to evaluate your unique situation. Many of the statements given throughout this class are our opinion and should not be construed as a recommendation of any specific security or investment strategy. Any references to previous investor experiences are not representative of all investor experiences. When reviewing the historical performance of various investments, keep in mind that past results are no indication or guarantee of future performance. Always read the current prospectus before investing. And just due to time constraints and varying degrees of student knowledge, some of the topics discussed may be covered in simplified terms. We encourage you to refer to our book, Active Retirement Investing: The Process, for more detailed information and a discussion of potential risks associated with specific investment products. We welcome students of this seminar to seek our opinion and services, but outside of the classroom if you so choose. However, we will not be soliciting any business during this class or program. You can contact these regulatory agencies for more information about the role and responsibilities of the broker-dealers, registered investment advisors, and their representatives. And we have the FINRA telephone and website on the board. And we also have the Securities and Exchange Commission, the SEC telephone number and website on the board. And just by remaining in this class, you acknowledge that you have read the disclosure, you understand the context, and you can request clarification of any part of this by giving us a call at 916-863-1266. We're going to try to get through all the slides today, but first we're seeing that you don't understand all the aspects just of a sample portfolio, so we'll try to go through an example report, fund report, and explain what the details of are there. Thank you and enjoy the class.
I'll get started here. We're restarting this class. It's going to be fun. We built this out with an office there, but kind of like a little cafe here to have some fun for future classes. And also, we'd like to invite clubs and groups to come up and use the place. Maybe investment clubs and stuff if our legal department lets us do that. Yeah, you could have dance, things like that. And hoping that we get more people doing this. And if not, I'll just build 2 more little offices. But I think it would be fun. That's what I've wanted to do. I own another building down the street, that Pete's Pizza down there. And so I was originally going to do this there, but then everybody wanted to rent it. And so bought that back in 2000. So that worked out pretty good. So this class is Active Retirement Investing. It's designed for people that are pre-retirement, in retirement, or post-retirement, meaning they did go to estate planning, right? They're not around anymore. I'm going to touch on an investment portfolio view just to pique your interest, and then we're going to come back to the beginning process of doing financial and estate planning and investment planning. Because in my opinion, I've done this for 45 years, what's the point of investing if you lose those investments either to long-term care costs or a lawsuit or something, or if you lose it after you die and it doesn't go to the family members you wanted it to go to? So what's the point? So we'll touch on some of the financial planning areas, but primarily we want to learn about investments as well. Without disclosing or asking too much personal, you guys are interested in the investment process, I assume, right? That sounds interesting.
I just didn't know what to do with my time. So
excellent. Okay, good. That's perfect.
And actually, I think this is exactly what I was looking for. I have a financial advisor, but I claim I'm not that smart about, let's just say knowledgeable about financial investments and stocks and bonds and this and that. I'm like, I think I need to educate myself.
Excellent. The subtitle of this, after whether you do it yourself, is whether you have an advisor. I instruct advisors from time to time. So we're happy to teach if that advisor is falling off the course, because sometimes they have a home office telling them what to do. And in the back of the book, you'll have a page of what your advisor should and should not be doing, in our opinion. And it's all about ethics and morals and codes. And the good thing is the SEC, Securities Exchange Commission, is now legislating or mandating ethics and morals. So most people working with somebody with investments should have a fiduciary responsibility to do what's right for the client. Now, you can get paid a management fee, you can get paid hourly, whatever's fair, but the investment process shouldn't be for the benefit of the advisor who might make a big commission. So, and I won't ask too much about your advisor, but if he or she is fee-based, they're fiduciary. If they sell investment products for a commission, they might be a great person, but there's a conflict of interest there because they could get paid 7 to 10 years fees up front, and then what motivation do they have to work with you after that? It's kind of like getting a roof done. Would you pay them in advance? Of course not, right? But the commission products I have a problem with, and I started that way because that's all we had years ago. But why would you pay somebody 5 or 10% commission up front and then they have no interest in seeing you again? And it always comes out of your investment. So we'll touch.
It's either fee-based, which is fiduciary, or it's, what's the other one?
Commission-based, yeah.
And so they're incented to sell you a certain product.
Yeah, and if they're with a big home office,
biased.
yeah, it's biased, absolutely. Their requirement is to make sure that investment fits your needs at the time. And this is all written in the book, so you can look at it there. And we've got 12 classes you can look at on the website at home and go in greater detail. So the only question is, do you have the time and do you have the interest? If you have the time and the interest, you can learn as much as your advisor knows. That's all, because they've read the manual, they've done the website, they've done the training. None of us are that brilliant that we can predict anything. I can tell you that this is down and it's maybe going to go up again. Healthcare was down quite a lot up until the last couple of days. Okay, let's buy that. Well, we don't want to gamble on one shot like that. So the good thing about financial advisors is we're required to look at the whole situation and do a layout of a plan that makes sense for you. Whether they're a commission-based advisor or a fee-based, they're required to do what's best for your best interest. So the regulators are getting really strict about that, which is really cool. So we'll touch on those points a little bit. This is a picture of a portfolio. So we're going to just show you what it looks like to whet your appetite, and then we'll come back to the planning process. But this is what I see when I'm looking at a portfolio. Pie chart we all have seen on your statements, right? Here's what you have. Cash, and this is among all the investments. Cash among all the investments that you have. We prefer to recommend mutual funds and exchange-traded mutual funds. It's a basket of stocks and or bonds, right? And so if you own one stock, it could wildly rise or fall or actually go out of business. We don't work in individual stocks. The risk is too great of loss. But if we have a mutual fund or an exchange-traded mutual fund, it's a new version, you could have the S&P 500 and you have a fraction of all those 500 biggest stocks in the U.S. economy. Now they're layered based on the size of the company. So Apple's probably the biggest, Microsoft, NVIDIA, and that kind of thing. But we would rather own part of a basket of a fund that if one of the stocks crashes, you might not even notice it. But they tend to rise and fall with the overall market because the market itself is what determines your cost of living and inflation, right? So I don't want to just own one stock that may or may not go up. I'd rather own several different company stocks. So as Walmart or Starbucks or anybody raises their prices, my stock can go up in value because its earnings rise. That's the only reason stocks go up. I expect it to go up in earnings in the short term or in the long term. Technology stocks, I expect it in the long term, right? But a Procter & Gamble or something, if they did something really wise, like using AI to improve their efficiency, I buy them for the short term. Give me a bigger dividend, so then the stock goes up. But some technology company, they don't pay a dividend. That's okay, but I think what they're doing is really cool. Well, I don't want to search one stock at a time and then be right this year and wrong this year and never really get anywhere. Because people that do individual stocks, they only want to tell you how great they were on their wins. They don't tell you about the losses, and you don't have a second chance. So we believe in a portfolio made up of about 12 to 15 different funds that in themselves have several different stocks, 35, 100, 200, or something like that. This is a picture of several funds, like 12 or 15 funds. We've heard of Vanguard, right? Vanguard funds, and you've heard of Fidelity. and you've heard of Schwab. And then there's some others that you may or may not heard of. iShares is a big one out there, and these other companies. So we create a portfolio with a mixture of funds from Fidelity, Schwab, Vanguard, and a few others. And in those funds, added up, you probably have 2, 3, 4, 5,000 stocks among them. So we don't want to put all our eggs in one basket. We want to have a great level of diversity. So just for fun, we'll look at a portfolio of what it looks like. It won't make a lot of sense, but then as we go into this a little bit more, things will start making sense and you'll start understanding it. Because if I create a portfolio for somebody, I need to know what's your objectives. Maybe it's there to supplement or be your retirement, or maybe it's there for the grandkids. So if it's for your retirement or to self-insure long-term care, we've got to be careful we can't lose it. But then again, we want it to grow with inflation. But if it's for the grandkids that aren't born yet, hey, let's go for it. We still want several funds, but we would have the most volatile, aggressive technology and funds out there because in the long term, they'll lead the pack. But it's all based on what your objective is. And then the other thing is, what's your time frame? If this money is there for you to pay off the house in a year, that's a different story. It shouldn't be invested in stocks, it should be in cash. But if it's a long-term investment for your late retirement or the grandkids, then some of the funds are acceptable because they could be up and down. Now, we've heard of the S&P 500, right? S&P you hear in the market. That's 500 of the biggest stocks. Worst case scenario, you guys are too young, but I'll take you back to 1980. There was a big crash and interest rates went up to like 14%. Another one.
I remember that, because I bought a house in 1988, it was like 8 or 9%.
Yeah, which was good at the time.
No, it was like
16. But
no,
that
16.
16.
Yeah.
But
terrible.
But that was the best time to buy the house because the price of the house was inversely low.
Right.
Then what did you do when rates fell?
Yeah, well, I made 100,000 in 3 years.
Yeah, yeah.
But
Interest rates were high, but the cool thing is about interest rates is one, they're all deductible, right? Two, back then you could sell the house and whoever bought it got a new loan if rates are lower, or you just refinance. And now you bought a cheap house because interest rates were high, but now you refinanced at low rates once rates come down. That's perfect. But the problem today is rates are high, and even if rates are modestly high, people are complaining they're really low compared to back when you bought. But even if rates drop a couple percent, prices are still way too high. So it's a dilemma for young people. That's why I would say, let's buy some land, put on a tiny house, a well and a septic, and then build a barn, and then build a house over time. Plus,
building costs are so high right now.
right. Yeah, and they may or may not come down.
I thought about that, but it just seems like it would be a lot more to do that.
Well, the permit would be outrageous. The building cost is outrageous. And worse than that, the insurance would be outrageous. So for young people, I'd say go up there, get yourself a metal tiny house and enjoy the property and save your money. And then when you want to build there or somewhere else, you could do that. But buying a house much bigger than they need or use, that's a problem because they're not wasting money in the long term. The house might hold or go up, but then they're draining their budget. So you have to be willing to do different things. Okay, so if this will come back up. So this is a chart. Here, cash, U.S. stocks, non-U.S. bonds, and all of that. We could talk all day about U.S. versus non-U.S., but usually U.S. has more growthy stocks that have more technology and things. So we do buy some non-U.S. just to balance things out. And when you're investing, you want opposites. You want like a bicycle wheel. The opposite of this spoke is the other spoke. We don't want to have all one thing. It's kind of like if you're raising animals, you want diversity of the gene pool in case some disease comes by and wipes them out. So this is a portfolio that is mostly stocks, but it has some bonds in it. And the reason the bonds are there is to be stable in case the market crashes. You need some money. They don't drop as much. Or they give you opposite positions and some earnings that you can be reinvesting. But you don't want to put all your money in the stock market unless that portfolio can be left there and alone for 7 to 10 years. You can always get money out. There's no strings attached at all, but you want to have a long-term horizon. And so we'll talk later about short-term, intermediate, long-term positions in your portfolio. Because in 2008, what happened back then? Do you remember? Yeah, real estate crashed big time. Stock market fell too. because of real estate bill. We're all in this together. Some people would say I make more on real estate and more on stocks. Depends on where you are and what position you are. So you want to be as diversified as possible. But the problem is, stock market dropped 65% within that 2008, 2009. And it was down quite a bit. Shaniqua, you want to use my office? Does she? Okay. So 65% within the year. It ended the year at 55% decline on stocks, right? Same thing happened, not as bad in 2020. What did the government do regarding the required minimum distributions? You guys are too young to worry about it, but people that have to pull it out, they have to pull money out at age 70, now at 73. The government stopped the mandate of having to pull money out of your retirement plan.
Wait, what
You
happened?
keep referring to us as young. I turned 75 yesterday.
Oh, okay, good for
So,
you.
just to put it in
Okay.
perspective.
Okay, well, good for you. You don't look
Well,
it.
I'm headed towards 70, so.
Oh, wow, you don't look it either. So,
Thank you for.
okay. I turned 72 last
72.
Friday. Yeah, okay.
So is that all there is stocks and bonds to
No.
invest in?
No, there's tons of other things.
Okay.
But the thing that we recommend is things that are catered to diversity within a portfolio, so you don't get hurt too bad if one stock crashes. But there's things that are called like funds, recipes. It's a fund that will go out, and the S&P 500 buys one of all 500 stocks. That's obvious. The Dow Jones buys one of all 30 in the Dow Jones index. All an index is somebody saying, I've decided these 30 stocks or the 500 is my index. They published it. Now companies pay to use that, and they come up with funds with the same layout. So if I use your recipe and I sell cakes, I got to pay you part of the money I make. So indexes are just recipes. They're a list of stocks. So there's a wide range.
So that's still stocks.
Yes.
It's just a different form of stock.
Yes. It's
more like a portfolio, or like you said, a recipe, right? But it's still stocks.
exactly.
It's just a combination of.
Exactly. And on the other end of that, there are funds that only hold treasury bills. That's all they hold. Or they only hold CDs. Or they only hold bonds. But if you want to get people to buy your mutual fund and you want to earn 0.1%, 0.5%, in some unfortunate cases 1% a year, if you're a mutual fund, if we put together a mutual fund and we call this the index that it follows, the baby boomer index, we get together and say, what are all the things you buy? What are all the things you buy? What are all the things I buy? Then we pick all the stocks that are represented by what we buy, right? So if I go to Starbucks a lot, we'll buy Starbucks. If I go to Home Depot, we'll buy Home Depot. And we'll create an index, has a list of all the top 100 stocks that baby boomers utilize, companies that we buy from. And then we predict that you need to have a baby boomer index fund because that's where you're going to make the most money, because baby boomers do have all the money, right?
But a mutual fund is still a combination of stocks.
Absolutely.
It's just a specific, again, it's like what I'm saying, it's still a lump of some stocks
Yes.
as a whole. They
Yes.
buy as a whole.
Yes.
As opposed to individual.
Yes, a basket
What
of
about
them.
treasury bills? Like where does that fit?
You can buy a mutual fund that only owns treasury bills and buy that mutual fund as a basket. So instead of all stocks, it owns all treasury bills.
What are treasury bills?
What are they? They're like CDs that you buy through the government. They're guaranteed by the U.S. Treasury. So a treasury bill or a treasury note or a bond, you could buy a treasury bond and it might have a long-term maturity. So you could know that, because if you buy a bond, whoever you buy the bond from, that's a note. We're borrowing your money. So if you want to be the safest possible, you sell it to the Treasury, who can print money and make the taxpayers have to back it up. So that's pretty safe. But if you want a higher yield, you buy a Treasury bond from a corporation, not a Treasury, a corporate bond from a corporation. They pay a higher yield, but you want to make sure they're going to stay in business. So a mutual fund can have Treasury bills, it can have all stocks, or it could have a mixture of stocks and bonds. That's the thing that'll blow your mind. There's so many companies out there that want you to invest with them. They're legitimate, but the way that Vanguard, Fidelity, Schwab, or anybody else gets paid is that they get a percentage of the overall value every year. The extremely high percentage is like 1% a year. That's too high, but some do that. Some old mutual funds that you might own, maybe you inherited they might still be charging 1% a year of the overall value just to own the mutual fund. Well, that's too high. We'd rather use Vanguard, who charges 0.05, 0.01, or Fidelity or Schwab. But a mutual fund is a basket of cash, stocks, and bonds, whichever they decide to select. It's like your favorite recipe. You might do something that somebody else doesn't do, and then you sell me your recipe, or I can buy your actual product. So up in the left-hand corner, we've seen that before. These boxes, I'm not going to bore you with the details, but this is what, if you have an advisor or if you do, we want to know what kind of stocks. These are large company stocks. These are mid-sized company stocks and small company stocks. The bigger the stocks, the less volatility, because they're already out there and they're already established. So if I buy an apartment building that's already fully rented out, I've got to pay a little premium because they've already done the work for me, right? I know what the cash flow is. I've got good tenants. Everything's great. So I like your building. But if you have an old renovated apartment building that people haven't rented from, it's unproven yet. So that might be considered more similar to a mid-sized stock or even a small company stock. So don't worry about the details here, but if I'm building a portfolio, I want to know what these things are, what percentages. So this column here is value stocks. Those are the old blue chip Warren Buffett stocks. It's like buying a house that's paid for and it's got rent. You're not going to do a mortgage or anything like that. You're not going to try to leverage it. Then over the other side, these are large, medium, and small growth companies, which are mostly technology or things that aren't proven yet, but they're building and going towards that direction. And then the ones in the middle are a mixture of both, some old Warren Buffett value blue chip stocks and some technology stocks. So this portfolio has, as a whole, has those. But what's important to me is this number here. If I have 12 different mutual funds, which are baskets with different stocks and bonds and cash in them, whichever one you pick, there's 3,749 different stocks among this portfolio. So if one stock crashes tomorrow, my portfolio represents 3,749. So you don't have to panic. Now, this portfolio could fall in value, and now you've got to wait it out. Or if you don't want to wait it out, then I'm not going to cash out my stocks. If the market crashes, I'm going to cash out my bonds, right? So in 2008, 2020, 2 years ago, whatever it is this year, 2025, 2022, interest rates went up, stock market dropped considerably again. Long term, I would say 7 to 10 years and beyond, I would swear up and down stocks are where you want to be. Put those dollars in the long-term bucket. But in the short term, less than 7 years, it's going to be dicey. They're going to be up and they're going to be down. So you want to allocate a portfolio based on your objective and then what your time frame is, and then your discomfort to volatility. But we're still going to have some that are going to be short term. They're not going to bother you at all. They're going to be heroes when the market falls. But when the market goes up, they're non-heroes because it's like cash. And then in the middle, we have some that can take a little bruising. And then long term, that's the hero section of, oh, I bought the S&P 20 years ago. But if you bought the S&P yesterday and it drops 50% today, that's scary. So it's not what you buy, provided they're legitimate. It's how you buy them. Layer things in a time frame. So, okay, those are meant to be long-term. Market just crashed. Maybe I need to move some money over there. The problem with humans is we get emotionally involved and we have recency bias. If the market crashed for the last few years, I'm not getting in. Well, no, that's the time you get in. If the market goes up too much, I'm getting in. No, that's the time maybe you step back and see, are there other areas, right? If you can stay with that and stay invested with mutual funds, or the new form of mutual fund is an exchange traded mutual fund. All that is something you can buy and sell like a stock, but it's a basket. Because it used to be if you bought a mutual fund, you had to buy it at the end of the day. They had to calculate the value, and it was the mutual fund company let you get in at the end of the day. Kind of like buying a house and having to use a title company.
This is a lot of stuff.
Okay, sorry. Yeah.
Exchange, okay, so there's a mutual fund called exchange something or other.
Yeah.
And that basically is one that you can buy and sell or trade dynamically as opposed to a non-exchange one.
Exactly.
Is that it?
Yep. And there's thousands of them. The markets, there's like, let's say 4,000 mutual funds out there. And now there's like 4,500 exchange traded funds. So it's kind of like in real estate, if you want to buy a house, you know that whole process, right? It takes a long time, title company, escrow, and all that stuff. I don't know how soon, but we know the blockchain is coming, right? Soon you're going to be able to buy a house overnight because everything's instant, right? Some people find that appealing, some don't, but that's coming down the pike because you can authenticate everything, your credit rating, all that stuff can be done instantly. That's where technology, AI, and the blockchain is going to go. And it's supposedly safe, so you don't have to worry about it. So if you wanted to buy a house as fast as possible, you put in the bid, yes, we accept it, it's done. And for whatever reason, you want to get it done. Then the house drops in value. That could have been a mistake. Maybe I should have stretched it out and decided not to buy it. So exchange traded funds, basket of stocks and bonds, are bought and sold like stocks during the day. There's good reasons for that, and there's bad reasons for that, right? You buy it at the wrong time during the day, and then it drops a lot, you're disappointed. So that's just a method of being able to buy something. It's kind of like if I go look at Corvettes, and all these Corvettes are on blocks with no wheels, but I still enjoy them, and I might buy one, and they'll come around and put the wheels on it in 2 days. Well, the exchange traded funds are Corvettes with wheels that are ready to go right now. So an exchange traded mutual fund can be bought and sold just like a stock. That's either good or bad. Day traders can make money and lose money. So it's not necessarily a given that that's the best thing in the world, but there are some tax benefits that we talk about down the road.
So are there regular mutual funds and then exchange traded that have virtually the same recipe?
Very smart. Yes, absolutely.
Really? So
Yeah.
you could buy, if you wanted whatever recipe, I could buy it here on a normal mutual fund, or I could buy it here on an exchange.
You're absolutely right. Yeah. And the reason that there are two is that the mutual fund companies like Vanguard want to get out of the business of mutual funds and in the business of exchange traded funds.
Why is that?
Why is that? Because when you buy a mutual fund, you send Vanguard a check or electronically, and then they've got to do all the paperwork, and there's tons of work behind the scenes they have to do. And then they have to wait until the end of the day and then take your cash and deposit it and then go buy the stocks to represent your shares that you want more of. The exchange traded fund, once Vanguard puts that fund out there, then you have to buy shares from other investors that want to sell it. So it makes it easier. It's more efficient. And we talk about that in the book with the details. The mutual fund, it's safer or not because you're going to buy it at the end of the day, and then they're going to take your cash and buy more stocks and then create more shares and give them to you. They would like to be out of the business of all that legwork, and they create shares of the exchange traded mutual fund, same thing, but there's a authorized participant, somebody else that has to go out, take the cash and buy the shares. So the companies want to get out of doing as much administrative work, but they won't ever totally be gone because there's reasons for that I don't want to bore you with. But that was an excellent question. If you want the Vanguard S&P 500, you can buy it on their website, wire the money, or send them a check, and you'll get the shares at the end of the day. And if that's fine, that's fine. But if you're a day trader or somebody that really wants to take advantage of where the market is this hour, then you get in your brokerage account, you buy it, and it's done quickly. That could be a curse. You could have done it and jumped on it, and then it crashed and everything was bad. So regular mutual funds are fine, but the exchange traded funds, in order to try to take shares, the market share from the mutual funds, offer lower expense ratios usually. Yeah, not always. Vanguards are fund for fund, so they've dropped their fees. Vanguard is the cheapest. Fidelity and Schwab have some that are the cheapest, but you got to be careful with them because you don't want to just buy a Schwab fund thinking, oh yeah, they're all cheap. No, not all of them are. But you could go to Vanguard and buy nothing but Vanguard, and you'll have the cheapest shares as far as expense ratio, right? So if you have a fund and you have $100,000 invested with some old mutual fund that hasn't dropped their fee, you could be paying $1,000 a year for just owning the mutual fund. But that same kind of mutual fund at Vanguard might be $100 a year. So we don't want to pay high fees unless what they're doing is something you really want. Maybe you want to get into cryptocurrency, and maybe there's a fund that charges 1%. You have all the most brilliant cryptocurrency people in the world, and you want to let them manage your money so you feel safer. Okay, we'll pay you a higher fee. But generally, you want to stay with low fee funds. And we'll talk about those a little bit later, and there's ways to look at those. Because the ones that have the very lowest fee have the least amount of internal management. They just buy one of everything and walk away. So you get what you paid for type thing. Other things here. This is a little box that tells me about the bonds. Hope I don't mess this up too much, but I'm trying to keep it from falling asleep. This little column here, LTD stands for limited term. So when you own bonds, it's kind of like if you sold your house and you carried back and did a mortgage for somebody. You're not going to give them a 30-year mortgage, right? That's ridiculous. You want your money back. So this tells us we have limited term bonds, low credit rating, junk bonds, high credit rating, treasuries, corporates, let's say, in the middle. And they're limited term, meaning you bought this bond, but it matures in 3 years or 2 years or 1 year. So you're not going to be tied up. Now, the opposite is true today. Now is the time to look at a little bit longer term maturity bonds, because what might happen to interest rates? They might go down. So if you own CDs, I'd prefer you own treasury bills because they're state tax free. CDs are taxable at the state level. So if you pay state taxes, you'll get your interest free on the federal treasury. And if you want to empower yourself and not have to use an advisor and buy treasury bills, then go to, ready? treasurydirect.gov. I always get that wrong, but I think it's right. treasurydirect.gov, G-O-V. And that's a website that if you wanted to, after watching some YouTube videos of how to do it, you could literally buy treasury bills, same as CDs, but issued by the government, and your interest is state tax free. That's a big deal if you have high taxes. Now this new SALT tax is going to $40,000, but still, this will help you earn interest. If you want safe treasury bills, the safest investment in the country, because taxpayers have to back it up. So not to say you should have all T-bills, but in this case, if we're freaked out about the credit rating and we want it to be safe and we're worried interest rates might go up, because I don't want to lock in a 30-year T-bill treasury bond at 4%, rates go to 6%, and now nobody wants my bond, right? So we stay with short term, but if grandma only had like $1 million to her name, that's a lot of money, but I'm just saying, and she needed $45,000 a year, then she'll commit to a 30-year treasury bond because she doesn't want rates to fall. Now, if rates go up and make hers look bad, that she doesn't care. She's still getting her $45,000. So anyway, you don't need to worry about this. We will learn about it, but when you're doing a portfolio, obviously you want to know what's where and what kinds of stocks does this portfolio hold, because a lot of advisors don't even know this, because they'll send the money to the home office for somebody to manage, and they'll say, what's your risk tolerance? Are you conservative, moderate, or aggressive? And you go on, what's that mean? So when I talk to people, I say, what's your objective? What's your time frame? What's this for? Is this late retirement, long-term care, self-funding? Or is this late retirement supplement your retirement? Or is this for the grandkids? We need to know that. And then along the way, what's your stomach for volatility? And if it's low, then we add more bonds and cash. And if it's high, then we add more stocks relative to that. And I can look at a portfolio. This one, by the way, I can tell you what its historical volatility's been, if I can get there. Well, here's a worst case scenario. During 2020, if I can see that January to March, this portfolio dropped 15.95, 16%. But the stock market was down 38. So that's when I have like, how many clients? 300 or so? That's when I call my clients on the worst day. Hey, guess what? You're only down 10%. What? That's terrible. The market's down 38. Oh, thank you. And we get clients that way, right? Because I can't predict what a portfolio is going to do in the future, but I can predict what it did in the past based on Morningstar and these other companies that give us this data. And This little chart here gives me a visual that if you held the exact same funds that you'll see as I go down the page, this is a history of what they've done. The maroon line shows you what you would have done if you were paying somebody else to do it, the portfolio, but this is net of fund expenses. This is if you did it yourself, you probably make 1% more. This blue area is the New York Stock Exchange, so actually your portfolio did better. But both of you fell at this time in 2020, so we know that worst case scenario, no guarantee going forward, but if I create the same portfolio, it was down more than half less than the overall stock market because it's not all the S&P 500, a third of which is technology stocks. This is made up of more conservative stocks, blue chip stocks, a little bit of aggressive stocks, more bonds. So most people, on average, want to invest a nest egg and get some growth to keep up with inflation. But if the market crashes, what if it didn't recover within a year or two or three? Then we needed to go and sacrifice those bonds to live off of, giving the portfolio more time. So these are visuals that, don't worry if it doesn't make sense yet. It will if you read through the book or you watch the other classes and come back to this one. You'll get this information.
Could read these bottom. So July of 2015. So it's a 10-year. Is this what I'm
Yeah.
saying?
Yes.
Right? So it's 10 years.
Yes. And if I can make it bigger here, always afraid to push the wrong thing. So when you set up a portfolio, if it's this one and you said, look, when everybody else is down 38% and I'm down 15%, I feel pretty good. Because main thing is, how do you feel about the investment in the time that you're holding it? If you feel upset because you had a broker sell you one stock and swore up and down this is going to go up, intuitively, you know nobody can do that. And they shouldn't be able to if they know inside information. But you know that if the market's down 38 and I'm only down 15, that's a win. And then we walk away feeling really good. I've had clients thank me, thank you, because they didn't want to drop 38%, and there's no guarantee it would come back. The stock market crash at 29 took 12 years to get back where it was. Who wants to wait that long? And the average decline of a big correction in a bear market is 6 years. So we need to make sure that we infuse some liquidity features if in fact those are needed. Now, if you said, no, I don't care about that, this is for the grandkids, like I said, that's another story. I don't want to bore you with all the details. The people that want to know what areas, this portfolio, let's say in technology has 23%. That's still fairly high. The S&P is probably more like close to 30. And we won't bore you with all these details, but it is fair, and you should be able to know what did this portfolio do in the worst case scenario within the last 10 years. You have a right to know that. And a lot of advisors don't bring these numbers up. I want you to see what could happen going forward with this portfolio, although I can't guarantee these numbers. Let's see. So that's interesting that when you do something, it shouldn't be any different than fitting yourself for an outfit, right? Don't they take your measurements and check everything? We need to do that here. This particular portfolio has 16 baskets of stocks and bonds or a combination of those. The first biggest one is called the Fidelity Total Stock Market Index. That goes out and says we're going to own one of every stock, little ones, medium, large, not just the S&P 500 biggest. We're going to own a cross section of all of them. So that one usually tends to follow the S&P, but sometimes they separate a little bit because it has small stocks in it and the S&P doesn't. But that's the biggest position here. Now, if you were to say, I'm just going to buy one fund, I just want to own one of everything, then you go to Fidelity. Their total stock market index fund is not 1% a year to manage it. It's not 0.10 like Vanguard. It's 0.015. This is a loss leader for them. Look at us. We're the cheapest. Come to us. And then you go buy another Fidelity fund. It might have a high fee on it. So you could go into Vanguard with your eyes closed, no problem. But Fidelity and Schwab, which are worth using, they have some of the lowest cost funds, but they also have some of the higher cost funds. So you want to be selective. So if you have somebody doing this for you, we don't want to just go buy any other Fidelity fund. If it has a higher fee, it better be worth it. The next one is SPDR. You might remember the ad called where they talk about spiders. That sound familiar? These are just a group of investments that. Hi.
Sorry.
No problem. Come on in. Shaniqua, do you want to guide her to the materials? Yeah. And we're doing a little brief analysis here, but the second fund here is called Spiders, and then it has S&P 500 in it. So up here, this fund probably has about 1,800 to 2,000 stocks in it in itself, and then the Spiders funds has 500 in it, right? And it's fun if you ever want to talk to somebody that thinks they know a lot, and you could say, well, I have a question to this person. How many stocks are in the S&P 500? And they'll look at you, roll their eyes, and laugh and think, you don't know anything. There's 500 stocks in the S&P 500. Why do you think they call it S&P 500? Well, there's actually 504 stocks because Google and a couple others have A and B shares. So that's just a little trivia to talk to somebody. And also, if they want to own CDs and things, but they have a lot of money at the bank. Maybe they think the end of the world's coming. I have 500,000 at the bank. No problem. I go with how people feel. That's the first indicator. Then we plan from there because we don't want to go opposite and then the market falls and they panic. But let's say they have a bunch of money in CDs at the bank and they're bragging about, I just renewed a CD and I got all this money. And then you can ask them, well, you must love paying state taxes. What do you mean? Because CDs are taxable at the state level. If you go to treasurydirect.gov and buy T-bills, those are not state taxable. And they are, in my opinion, safer than CDs. Now, CDs are backed by FDIC, and that's backed by the government, and they'll just print more money and cause inflation. But those are little details I get a kick out of. So here's a portfolio with 16 different funds, some of the lowest cost funds out there. The lower cost funds are going to be the ones that buy one of everything. They don't do any manipulation of the portfolio. Fidelity buys one of everything in the total stock market index. Spiders buys one of everything in the S&P 500. The Vanguard Dividend Appreciation Fund has their own select cutout, but they buy probably 100 stocks, we'll see later, that are low. They have a low cost for their management fee, and they'll buy funds that have dividends that appreciate over time. So their goal is, we're going to buy companies where we looked at the books and they're starting to improve things. Now, the thing to do today would be, if I'm Vanguard, I'm going to look at the companies that are starting to efficiently use AI to improve their production. And if they are efficiently working and potentially making a little better profit, that means a bigger dividend or buying more companies within that stock. And so I'm going to buy, if I'm Vanguard, I'm going to research companies that are on the cutting edge of AI so those companies can improve their production and make more money. And if Vanguard owns their stock for you, then they get bigger dividends or bigger things. And so that's a fund called Dividend Appreciation. We're utilizing companies that are growing their dividend. Just like if you were to plant a bunch of plants, the ones that start creating more flowers or fruits are the ones you keep, and you might get rid of and plow under the other ones that aren't producing. So Vanguard's good with that. But all these funds here are low expense ratio. Now here's a fund with a company called iShares. We don't normally hear about them, but they're the biggest company that has exchange traded mutual funds out there. And that one's, it's called MSCI, that's just an index, but United States, MinVol, that stands for minimal volatility. So they're buying stocks within the United States that have a history of low volatility. They don't want the ones that go way up and way down. They want ones that are going to be more stable and have been more stable in the past. Again, we can't guarantee that they will in the future, but they have been in the past. So if you say, I don't mind investing, I just want to own a fund that selects the least volatile stocks out there so I can eliminate the gyration as much as some of these wildly up and down stocks might do. Recently, it would be tech stocks. Tech stocks have the most potential long term, but in the short term, it's a massive volatile roller coaster ride. I had fun with an intern yesterday where he was talking about, oh, you should buy AI stocks and AI mutual funds or exchange traded fund. I went, let me go to the car. I bring up my notepad. I tear out a page and I said, here's some AI stocks and mutual funds that I researched last year. And although I thought this is where it's at, but the risk was just too much. I don't want to take that much volatile risk. Now they're up 60%, right? And I could have bought them and be up 60%, but I could have bought them and they could be down 60%. I have some funds that use blockchain and I bought them too early and I saw them drop 60, 70%. That's a mutual fund, an exchange traded fund, only because it did everything with AI. But then now it's broke even, or I'm probably up 20%. So just because I think something's going in one direction doesn't mean it will. So that's where you play with your Reno money if you want to do something like that. Whole nother concept. But this fund is the opposite. If you say, I want to be in the stock market, but I want minimal volatility, instead of going up and down 17%, it might go up and down 12%. Still going to be volatile. And that gives you that choice. Now, we put this one in here because people may have heard of it. There's a company called Invesco, and it's the QQQ fund. Anybody hear of that? I don't know why they came up with that name, but it's all technology. And it's done massively well. But not because the fund is working really hard under the hood. It's because they bought a bunch of good quality, biggest technology stocks 20 years ago, and they've had massive ups and massive downs. And when they're up, they're really up. And so they advertise on television quite a bit. So you'll see the QQQs. There's no little secret to anything. If there was, then there would be no stock market, right? If I knew what was going to happen, I would buy this and buy that. I would win, and I would take all your money.
So I have a bigger picture question.
Yeah.
Right? So breaking down all these little things. Say if I were to look at my current investment portfolio, or even decide or have a piece of deciding what I think would be good outside of what my guy's doing, do you take these particular things and look at their history? Or how do you actually know, how do I actually know, oh, it's good to have the iShares and the QQQ, and I should have 10% more here. How am I supposed to know? So it's one thing to know what those things are. It's another thing, how am I supposed to decide what percentage of my portfolio I put it to?
As far as the portfolio goes, if you took 15 different funds and put them in the portfolio, we start by, let's say 10 funds. We put 10 funds in a portfolio, 10% each. Then we run this report and go, oh, yikes, that's too risky. Let's reduce this 10% to 5%. Oh, that's still not enough of this. And then we reallocate it.
How do you know it's too risky? 10% across the board, and then how do you judge it's too risky?
Yeah, we do it with a what we call parameter down here. Historically, I can't go forward, but I can go historically. I would look at this portfolio and see these numbers, which we'll talk about later, but this thing is called standard deviation. And this is the portfolio itself for the last 3 years. And this is the benchmark, which is the New York Stock Exchange. And then it has 5 years and 10 years. So for the last 3 years, this portfolio's average volatility from its norm is up 10% or down 10%. So its average volatility is about 10% or a little bit more than that. The stock market itself is about 14, 15%. Or 10 years, this portfolio, if you said, yes, let's invest in these funds, I can only say historically, you would have had about 11% average ups and downs, and the stock market was 15, so we're about 2/3 as risky. And you'll learn later, don't worry about it, but there's another calculation here that it's called beta, and this tells me this portfolio as a whole is 0.71 or 71% as risky and volatile as the broad stock market. So if you were to say, look, I can only handle emotionally, I only want to be, what I start with is, okay, you gave me $100,000 through no fault of my own, next week the market crashes. How do you feel if you drop down to 70,000? Oh, yikes. Okay. How do you feel if you drop to 80? How do you feel if you drop to 90? You say, okay, I can handle 90. I can't guarantee that. But we look at a portfolio. In this particular case, this one would have dropped in 10 years, an average 11% might have dropped 11,000 or 12,000 or so. So the first thing you want to do is get some feeling of what's the objective, what's the time frame. Because even if it drops more than your comfort level, we can say, hang on there. We talked about the time frame is X, or part of the portfolio has money in reserve in case you need to pull some out. We'll cover those also. But this is what an advisor or you or a family representative should look at, is that I want to see historically over 10 years, this fund's been 71% as risky and volatile as the overall market. Most of my clients are more like 0.50, half as much, because they're in retirement and they don't want that much risk. So this one is a little more for the pre-retirement person. And then this little thing, don't worry about it. It's called alpha. How much better did this portfolio do than others like it? This portfolio did 2.66% better than other portfolios in the market that had a mixture of other funds. Why? Because we go for the lowest cost, either index fund or exchange traded funds, and get the portfolio expense down as low as possible. And then the other question is, how do we pick a fund and we know that it's a good fund? I'll show you that a little bit later, but we want to look at the history of the fund compared to other funds that are exactly the same or very similar. So if we have a fund, and Morningstar, this company, will give you a 1 to 5 star rating, not their opinion, but if it's in the top 90 to 100%, it's a 5-star rating for the last 10 years. If it's a 1 star, there's something wrong with this fund. If it's a 3 star, it's kind of average. So we look at a chart I'll show you. This is the portfolio. I'll go back to the funds, but we like to look at a mountain chart and see, is this fund doing as well, or has it done as well as other funds just like it? We don't want to compare it to apples and oranges. We want other funds. And if it's done better than them, it might be because their fee is lower, or maybe their setup is a little bit better at that point. So this, we're cheating on this because we just want to show you, this is the portfolio example. Once somebody asks you what's your objectives, what's your risk tolerance, what's your time frame, and a few other political things, do you want, certain types of funds, don't want that. Then when they create the portfolio, and in our opinion, the advisor should be creating the portfolio themselves, because we want to listen to the customer and find out that we know they don't like alcohol stocks or this stocks, or they do like alcohol, whatever. We want to create something that's almost not completely, but a little bit politically correct for that person. And also for their fear factor. They might think the market's going to take off or the market's going to crash. We need to work with the client, because if I just take the money and do what I think is right and it goes up, you're going to go, oh, good job. But if it tanks, you're going to be pretty upset, thinking, oh no, did I make a mistake trusting this guy, right? So it's got to be tailored more to what your objectives are and your time frame and everything. And that way, if the market tanks and I say, hey, guess what? You're down 10%. Oh, does that mean that the market's down more? Yeah, they're down 38. Now you're a happy camper. And you might even send more money in, because you know that investing when the market's down, overall market, is a good time to add if you've laid out your whole financial and estate plan properly. And that's where people make the money. They don't have some intuitive, oh, I know this is going through the roof. Last year, when I had those stocks that I wrote down in the funds, I didn't buy them because the risk was too much. But had I bought them, I'd be up 60%. Was I wrong? Not for me. I'm not going to risk buying another tech stock or fund that dropped 70% for 2 years. They're in that category. It's like Bitcoin. Should you buy it at $120,000 a share? What if it goes to 150? You can do that much gain on it in other stocks. Why take the risk? Now, the people that bought Bitcoin when it was 50 cents, they bought it for other reasons than making money. They were into that type of thing. Get away from the government, hide the money and all that stuff. So when we go down, if this will go down more. So these are little parameters that whoever's constructing your portfolio should know all this stuff. We're not going to take a ton of time, but if you just wanted to scan over and say, okay, what do the bonds look like? Here's the bonds. AAA rated are investment grade, good investments, and then A and all the way up to AAA. You get a better yield on a lower credit rating, so we need to know that. You don't need to worry about the bonds, but there's things in the book, in the class, called duration. What's your bond risk? What if interest rates went up? I've seen people lose 40% on their bonds in 2022. When the Fed raised interest rates, if you had a bond paying 2%, and now that same bond pays 4.5%, the person that owns a 2% bond can't sell it to anybody because nobody wants 2%. So they have to lose a bunch of value. Don't worry about that, but your advisor should know all these parameters, everything. And if they don't, give them the book. We're happy to have them watch the classes. We'll train them. But just handing money over is not a good thing. The average mutual fund charges upwards to 0.75%, 0.75%, to manage the mutual fund itself. Okay, here the average expense ratio is 0.12. We want the lowest expense ratio you can get, unless the fund's jumping through hoops and doing some gymnastics. I do gymnastics, but I won't charge you for it. 0.12 is really, really low, right? There, you could get to that Fidelity Fund Total Stock Market Index 0.015 if you're just going to own one fund, but this is a mixture of several. And when we build a portfolio, we want to look at it. Now, if I can go backwards without messing this up. Okay, so I need to move this. So I'm over here. Okay, then I'm going to slide this over. I can get it over there. Okay. Okay, so this is a list of the funds that we just talked about, right? And the top one in that portfolio, there are 16 of them, and these are all different funds. And remember, what was the number? 2,000, 3,000, whatever. We have thousands of stocks in the portfolio. Some of them represented in this one, I'm guessing, we'll find out in a minute, 2,000 stocks, let's say. So this is the biggest holding, and this is Fidelity Total Market Index. It's the lowest cost fund that I know of, but it's their loss leader saying, hey, we've got the lowest cost fund, and now buy our other funds that have higher costs. So you want to search the cost of a fund. If it has a higher expense ratio, high to me would be 0.5% or 0.35, and they better be doing something good for that. But if it's a cryptocurrency, best people, smartest in the world, okay, I'll pay you 1%, but it better be worth it type thing. Okay, so this fund, you might not be able to see it, but it's got $113 billion in it. Shaniqua, should I click here for bigger size, or am I going to regret it?
No, I think you should.
Click it? Okay. Okay, so it's got $114 billion in it. It's very big. You'll learn later that if you get a fund that's got very small numbers, they're not going to take advantage of you, but the cost to sell it, the spread could be greater. It's kind of like real estate, the buyer versus the seller. And so you want a fund that has a lot of money in it and a lot of money coming in and out, because if it doesn't trade much, its price could fall or rise a little bit too much. Unless you're familiar with that fund, that's fine. Here's the expense ratio, 0.015. That's really, really low. Not all funds. We use some that are 0.35 if they're doing something we need them to do. The fee level is low. And this is a company called Morningstar. You can go and they have a sample, right, that they can look at. You could put your funds on in there. Load. Morningstar is an investor software program that you can subscribe to, but they have free subscriptions to get you to subscribe. So Morningstar takes all the data of all of the stocks out there, all of the bonds, all the mutual funds, every investment out there, consolidates it, and then you can extract that information. So I can go to Morningstar and get this information that they created for me for this particular fund.
So I could look at all the funds that are invested in certain areas and then look at Morningstar and see what it's going on.
Absolutely. You could look up a stock, you could look up an exchange traded. Here's what they should do. And they should, in my opinion, create their own portfolio for you or a model that they use for their clients, but be very aware of every single fund and what's going on. Now, if you go to an advisor with Fidelity or some other company, you might find out that there's a lot of Fidelity funds in your portfolio. And so Fidelity's getting the management fee maybe and the advisor fee. That's a little too much. So hopefully they don't. I can't say that they do, but so on here, the dividend yield is only 1%, but you've got stocks in there, you're there for growth. So up here, This is a word index. That's because they buy one of everything in this published index. So whoever published the total market index of, let's say, 2,000 stocks, they created a fund saying, look at us, we're doing the same index fund. They have to pay a fee to use that name. And because we're not managing and buying and selling and trying to beat anybody, we get 3 out of 5 stars, which is neutral. Meaning, I don't expect them to be 5 out of 5 because they're just doing one of everything. So they're not really doing anything. But they are ranked as a gold-rated fund by this Morningstar company. And that means that Morningstar likes the way the people, the reputation, the way that they research, the way that they buy the stocks. So if you get a gold fund, it does not guarantee next year it's going to be up. They're not saying this is a winner. They're saying everything, the engine under the hood looks great. Now go race. That's up to you. But the parts and the way they do things are very good and very respectable. But even if it was a neutral, it might be a little different and not have a lot of funds to compare itself to.
So the stars or the rating of gold or whatever doesn't really equate to the profitability that you can achieve on it or the performance.
Possibly. Yeah, the stars go historically, so its performance compared to other funds is neutral. So it does tell you, yeah, a 5-star fund would be its actual performance. There's a word for that. I wanted to say it sounds smart. Quantitatively, right? The stars are a quantitatively ranking. So if you had 5 stars, it would be in the top 90% of all funds like it. This one's only 3 stars, but it's an index, so they're not trying to beat anybody. They're just the same as everybody in the category. So it's kind of like a race. This one came in the middle of the pack, and if it's a 5-star fund, it ended the race in the winning part. So if I'm going to pay a little higher fee and they're doing something, I'd like them to be a 4 or 5 stars, meaning they have a history of doing better than everybody else like them, right? So I'm not worried with an index fund. They just need to come in the middle of the pack. The gold tells us that the company is respectable, the people are good, their process is good, but it doesn't guarantee that you will make money. It just guarantees that this engine is in really good shape. So it's up to you to run the race. Then when you go into this, and again, don't be intimidated. We'll learn a little bit more about this stuff later. But this is the chart that I like to see. The blue line is this fund, and then the red line is the index. And the yellow line are other funds. Let's see, the yellow line, the yellow is the index, and then the red line is the category. So it's done almost as good, or in most areas, the same as the index. So you have an index fund following the index, but because it has a tiny little fee. Yes. Index would be a one of everything. So if the S&P 500 has one of all 500 stocks already in it. So the S&P 500 is an index. The Dow 30 stocks, have you heard of the Dow Jones? They have 30 stocks. So if somebody writes out, here's all 30 stocks, that's an index. So if you want to buy the Dow 30 stocks, but you don't want to buy them individually, you can buy them in a preset index.
Just another name for
the grouping, yeah, and it's all of one. An index fund would be similar if I hire you to go to Whole Foods and buy my groceries, and you just go off the list and buy the groceries. You don't go, oh, Bill, I found this new thing. It'd be really good for you. Nope, that's an index fund. Go buy me the stocks off the shelf and list them on the top 30 for the Dow or the top 500 for the S&P. And we have those index explained in the book also, so you can flip back there and get all this stuff. So that's what we want is this fund does about the same as the index, but we're not surprised because it is an index fund. And other companies like Schwab and Vanguard will have a total market index fund also, but they have to pay a little subscription fee for somebody that does the math.
So why isn't the yellow line and the blue line identical?
Because this fund might not actually own all of the stocks that actual index does. It might own 98% of them. That's what I found. My other excuse would have been because their management fee reduced the return because an index fund doesn't have a management fee. But this one, the expense ratio is so low, it can't be that. So they have a little bit less of the index and holdings. But if you want the lowest cost fund out there, this is one of them. Now, Fidelity has a few index funds that you can buy for no expense ratio, but it's that instead of a toaster. They're trying to get you in, right? And that's okay if you want to select and pick the ones that you want. So if this was a higher expense rated fund, and this was the average or the index and the funds up here, well, this is net of their fees, so I might be willing to pay a higher management fee. And so if they're doing something that you don't get in an index, one thing might be preferred stocks that pay high dividends, or one might be Bitcoin if you did something like that. If you're in a Bitcoin fund that their performance is here and the index is down there, okay, I'll pay you 1%. It's kind of like paying somebody to watch your car type thing. But you need to know, or whoever's doing this for you, need to say this fund charges more, and I'm sure we have one in the portfolio that it's worth it or not. This is 2024 year to date, 10% if these are up to date. 2023, but then into the year down 19%, where the S&P was down 38, into the year probably 30%. So this fund is a little less volatile than the S&P because I'm going to assume not as much of it is in technology, but it does get fairly similar. So you're not going to avoid any downside. And you could spend all day looking at this, and that's the fun of Morningstar. As we get older, even though you guys don't look at, you say you're older, well, if you're worried about what am I going to do with the rest of my life, there you go. You can learn this stuff. It's like a new language. You don't have to go to France or anything if you want to. But when you come out of this class or reviewing the book, you'll know at least enough that if you ask your advisor, great, okay, how's it doing? What's the standard deviation of this portfolio? He or she should know, okay, historical volatility. How did it do in 2020 when the market was down? Were we down less? I don't expect to be up as much if you want to be down less, right? My goal is to give clients half of the risk and 3/4 of the gain. That's our objective. Can't guarantee it, but that's where we want to go. Because most people, it's a nest egg investment. Like I said, if you were gambling and said, I'm in an investment club and I've got 1 year to gamble and make the most so I can brag to my friends, that's a different story. I would have bought those quantum calculating stocks, which they still can't calculate quantum, right? Physics. They know what it is, but they're not efficient at using it yet.
So how'd you come up with half the risk and 3/4 of the gain?
Just my philosophy. And you'll see it's not 100% that, but when we get down to the risk model, it's less risky, but you don't get as much gain, and you find an area that you're comfortable with. But that's kind of my goal, because in April this year, the market tanked like 20% intraday during the day, or 15%. But I'm looking at my clients looking, what? We were either not down, up 2%, or down 3%. I was like, what's going on? We just got lucky because bonds now are paying a high enough yield, they hold their value. And for whatever reason, all our conservative stuff held up pretty good. But normally we're down usually half as much. Now, 2020, we were down 60% as much. And I'm going, what did I do wrong? What happened then is when COVID hit, prior to that, and now you buy stocks based on their future income. 10 years from now, this tech company will make a big dividend, or what they're doing right now. So right now, if you buy dividend stocks so you have money to reinvest, then you like stocks that pay money to reinvest, that don't reinvest in themselves. They pay bigger dividend to you, and they don't expand and go buy data centers and all this stuff. But when COVID hit and we thought they're going to shut down all the businesses, that's like owning a dairy cow that no longer is allowed to produce milk. We can stomach volatile markets as long as we got our 2, 3, 4% dividend. Okay, yeah, I'm buying more shares, or at least I've got the income. But if you're telling me they're going to shut all these farms down and all these things, and I'm not going to get my dividend, then the dividend stocks that we used to hold for the dividend crashed more than tech stocks, because tech stocks you didn't expect to pay a dividend. And I'm going, what? It took me a while to figure out that this doesn't make sense. But if you own dairy cows and you're not allowed to produce milk, what do you think the price of the dairy cow is going to do? But the steer over here you're raising for 5 years from now to produce meat, you're not worried about short-term values. That's just my experience. 45 years of watching this stuff. And I always get a kick out of people. I don't have time to watch it. Watching's not going to do anything. You know, it stresses you out or it maybe helps you a little bit in some areas. Morningstar will take this portfolio and it calls it an aggressive portfolio. I wouldn't agree as much. I think it's more
moderate, but if you want to get their opinion, you can do that. There's a million things here you could learn. We don't quite have the time to do all that. But this little chart here, risk analysis, from left to right, this is volatility diving board. So it's getting more volatile and more volatile. This fund, well, now I do agree. It is kind of aggressive. I thought I was looking at the portfolio.
So this particular fund itself, in the blue line, is very similar to the maroon square in the index. So they're both kind of as volatile, about 15% up and down, and they both have a very similar return. So that fund itself is designed to be similar to the index, so that's why it is. There's the expense ratio of them, 0.015. Here's the average cost of a large cap or capitalized company, no load, no commissions. Their average expense ratio is 0.78, right? So if you're buying one of everything, index funds, we don't expect them to do gymnastics and make us a fortune, just keep up with that type of average, then we want the lowest cost funds possible. They're going to be 0.015 or 0.05, maybe 0.10 if it's a part of the economy like healthcare or technology, if they're doing something specialized, but buying one of all the top stocks. So that wakes us up and we say, this is pretty cool. I like to see that. Then when we come back here, we'll get to what it holds. These are general areas. Equity is a word that is in exchange for stocks, right? So if I have equity, I own stocks. Your portfolio is mostly equities, mostly stocks. And then fixed assets would be bonds. It's all U.S. stocks, right? Because it's following the overall U.S. stock market. Price earnings ratio we'll talk about later, but I'd like to get just down to let you see this following the overall stock market. Like the S&P has 32% in technology. That's a lot. So even if you do a total stock market, the biggest companies are still tech companies. So they end up making up most of this. Now, you might say, well, I don't want so much technology. I don't want to go to the S&P 500. So then you pay a little higher fee, 0.20, 0.25, and you get an S&P equally weighted fund. Instead of all of its money being weighted towards technology, it just gives everybody 1/500. So you'll own NVIDIA, but you'll only own 1/500 instead of 8% of it. Because the S&P is all the biggest companies and they're weighting. Whoever has the biggest share value like Apple or NVIDIA, then you're going to have a big piece of that in the S&P. That's good when they're up, not good when they're down. But if you want to be in the S&P but equally, then you get an equally weighted S&P 500 fund. Historically hasn't performed all that great, but then when the market falls, it's not all in technology, so you don't get beat up. So this gives me or the advisor or the portfolio manager some information of what you're doing. Now when we get to the top holdings of the portfolio, and I was trying to guess at what they hold. Oh, wow. Okay, 3,840 stocks. Now the biggest dollars are towards the biggest companies, right? But you've got 3,800 stocks in this fund alone. That's amazing. Good if you want to not have all your eggs in one basket, but not so good because then a lot of those other stocks might not do much. But it's always nice if you worry about the end of the world, some of these companies failing. Although you've got to keep an eye, here NVIDIA is 6.4%. That's a big position in a portfolio like this, but it's not bad. So if you've ever thought, if you own this fund and you thought, I should buy some NVIDIA, you already own it. If you have other funds out there that are regular growth stock funds or whatever, you probably own it at this time. Now, I've had some clients say, I want to divest, get me out of those funds that own NVIDIA in a large percentage, so we move out into something that has less, because he thinks that it's peaked out and AI is not going, even though it's amazing, not everybody can afford to do it. It's been around for a while, right? We've all watched 2001, Space Odyssey. So it took a while to get going. It might slow down simply because we don't have enough power to power up all these data systems. And then the cost of doing it. But we'll work around the edges and get some really cool robots or things that'll help increase the efficiency of the companies that are in this very portfolio. And we won't talk socially, but if you're worried about being laid off and losing or not being a part of AI, owning stocks keep you in the game, because almost every company is going to be looking at AI to increase their efficiency. And if they become more efficient and earn more money, the value of their stock goes up, hence your shares go up in value. So even if we don't like it, we need to own a part of the overall markets, or you do get left behind at that point. So this is the top 1 page out of 10 pages. NVIDIA, Microsoft, Apple. So we know all those. Amazon, Meta, Broadcom, Alphabet is Google, Berkshire Hathaway, Tesla, Alphabet C, there's that other class, Google. Any stocks you don't recognize? Right? Now they make up more of the portfolio, but you could go to page 2. How do I do this? Oh. Same question. So if you own this fund, you have 3,800 stocks. The biggest ones are the big ones in the market. It probably will rise and fall similar to the S&P, but it still has quite a bit of more depth in it. But from Johnson & Johnson, JP Morgan, you have a big mix of stocks in there. So you own a little bit of everything. Home Depot, Palantir, I've heard of on the talk shows. They're big in technology. A little bit of Philip Morris, not great. And some clients say, I don't want anything to do with something like Philip Morris. So there are funds out there, environmentally, socially, and governance designed to where they'll exclude those. You can do that. There are funds. And then if we're a fund, we say, okay, let's design a fund that excludes Philip Morris and this and this and this, and then go to the market saying, look at us. We're the S&P 500 X cigarette and this and this and this. We'll buy all the S&P, but not the smoking and the guns or anything related to something. And there are funds out there you can buy that are all S&P minus those objectionable stocks. But instead of 0.015, you're going to pay 0.25, 0.35 for somebody to do the work. And so the management fee of a fund is not a bad thing as long as we're getting something in return. And so some people swear by, I want environmentally, socially, governance funds that exclude all the things they don't like. And in some years, it didn't do so well because most of them are in technology. It's hard to have women on the board historically on oil wells and rigs, but in technology they could be, or less carbon footprint. So a lot of the ESG funds tended to be in technology, which was great when tech is up and really bad when it's down. And I told the people that's a commitment you make. Now they're way up again. So we got past that tough time.
Bill, was ending at 11:30?
Yes.
Because I'm sorry, I have to get to another point.
Okay, good. We're here next week.
Yeah, I'll be here next week.
Yeah, okay. And anybody that you want to drag them in and have them come in, do it. Review the book. If you want to go to the website, look around. We have those 12 classes, right? And any friends can download it. If your advisor wants to learn, he or she can come. We're not here to, talk ill of them. They're the ones that really need to come. So that'd be cool. I do too. Which firm do they work for?
Edward Jones.
Stick around.
Yeah.
Yeah.
Well, that's why I'm here.
Okay. Yeah. Stick around.
What's going on.
Yeah.
Okay. Thank you so much.
Okay.
This has been great. I've
Take-
had a lot to learn.
Please take the mug with you and the book.
So you're going to basically cover everything in here? Or?
Yes. Yeah. Okay. So we'll see you next week. The other two people will stay here. Anybody you can get to come, take that mug with us. It's kind of fun to have tchotchkes. Okay.
Yeah. Okay. Thank you.
Have fun. Okay, so we recognize all those stocks on this page, right? If in fact you like them. If you don't like them, then you've got to pay slightly higher management fee and you get them excluded if you didn't like them, right? Then page,
How prevalent with your clients is, how many actually want social responsibility?
I would say 5 to 10%. Yeah, and sometimes we'll have a complete, or all of a sudden they decide, you know what, I want to do this because they don't need the money anymore, and maybe they just want to be safe and be politically in their environment, so we can do that and change it. But some of the things that, like that other company, is that the company decides for them and they allocate them. We would rather have you, if you don't do it yourself, hire an advisor that's going to sit down and say, okay, yeah, we can do that. Now, in the back of their mind, they're going, oh, great, I've got a lot of research to do. But that's what they get paid to do. And so they should be doing that. So 5 to 10% is my guess. I'm going to go back up. Now, this was the total stock market index fund. And I'm going to come out of it. Is it safe to come out here, I think? Okay. So here's that QQQ fund that normally you wouldn't just go out and buy it unless you said, look, technology's taken off. I've got a few extra bucks. I'm going to have fun. Then it's mostly technology. This fund itself is in the top 5 stars. It's in the top 90 to 100% of all other funds like it, right? Morningstar's neutral on how they do things, but that's not necessarily a bad thing. And the volatility is likely going to be more. Moderate or fairly more. This is them in this dotted line. So they far out produce the index or their category. So if they have a higher expense ratio and it might be slightly higher, it might be worth it. But falling from here to there is a big fall. You've really got to have the faith that this particular technology fund and these stocks are good to wait it out, because it went from this time, which was 2021, maybe all the way over here to 2023. 2 years of massive declines. How do you feel about that? Now, with this fund, if it represents 3% of the portfolio, 5%, then we need this to put it in there to offset everything else. Because sometimes something with a little volatility offsets all these other things. They're opposite of each other. There could be times where the overall stock market falls, but this fund doesn't. But generally speaking, this fund is far outperformed, if you want to be in this area, everybody else. Now, because they have a neutral, maybe it's a little bit different management that Morningstar's not quite comfortable with. Again, you can look up Morningstar and get a sample use of their software. Some pretty big numbers here. Let's see. They dropped slightly more than the index, but they're up 54% when the index is only up 36% here. Now, we don't want to say I'm going with this fund because they outperformed everybody in the past. You need to find out what it is they're doing to outperform, right? It's like a friend of yours said, hey, I went to the amusement park and I had a blast. Well, what was so fun? I'm not telling you, you have to go on the same ride. And you get there and it's like, this is too much for me, right? We need to know, why did you do so well? And if it makes sense, I accept that. But we've got to be careful. Because with the quantum theory and company stocks that I looked up last year, and a fund that I said if I was going to buy one, I would buy it, and it's up 60%, it still had massive risk. So the risk itself, I wasn't ready for that or wasn't interested. But if somebody came to me and said, I've got to have it, that's why I had looked it up. And I haven't had clients ask. Usually people ask for whatever's already up instead of what might be. What might be hasn't taken off yet. Let's see. What am I looking for? Oh, the stocks. Yeah, this is a very aggressive fund. So the last one was a total stock market index fund. This one is considered very aggressive. So if an advisor or an investor wants to know Morningstar's opinion, they'll tell you. They're a little bit above average in certain returns, although we've seen some good numbers so far. The only reason I'll have this in a sample is I want people to know that we're looking at the most popular funds out there. And if this fund fits, it's nice for a client to go, oh, I've seen that. Oh, I get some QQQ, because you get all these great little ads and things. But it doesn't guarantee that you'll make anything. The index is here, and whatever they do a little bit better than the index. So maybe they buy different stocks are a little bit different than that, because this is not an actual index fund.
So when you said these are popular, the other one had 170 billion, I believe. What,
Yeah.
What is this one as?
I'll go back. It's going to be.
My question is, how popular is it?
It's very popular, but I don't remember or know, so we'll find out. $371 billion. More. Yeah. The other one has other competitors. That other fund is cloned by several others.
So this is unique.
Yeah, this has fewer funds like it. Plus, this was one of the first ones that came out, and a lot of people liked it. And you could do another fund that's similar, but it is huge. And the reason that it's important is if you go to sell the shares and you want to sell it quickly, you want a lot of people buying and selling. That brings the share price more in line with what it should be. If fewer people are buying and selling, you might sell your shares at a low price because nobody wants it. There's not enough people trading it. That's the other thing that you or your advisor should be doing. I've wanted to go, I want this fund. This is really cool. And my son manages the client's money, and he goes, nope, can't have it. There's not enough activity. We don't want to buy it at too high of a price because nobody's buying, or too low of a price because nobody's
Are you referring to EFTs or?
Exchange traded funds, yes.
Okay.
Yeah. Mutual funds, we're mostly into the exchange traded funds because they have lower fees and more tax efficiency. And we'll talk about that later. They're more tax efficient. A mutual fund could trigger some capital gains, which you might already get at the end of the year. So if you have an old mutual fund and by April you go, what? I didn't get all that money. No, they paid out a capital gains dividend and they reinvested it, right? Yeah.
I thought EFTs were more capital gains oriented because you're trading so much so often.
They would be for you as the trader. You buy and sell, and if you make a gain, the exchange traded fund, ETF, is going to cause you, if you're a day trader and doing that. But internally, the mutual fund at the end of the year decides, let's sell this and buy that, and they take a massive gain and they just reinvest it all. You pay the tax on it, right? But the cost basis goes up. The exchange traded fund, if they get rid of a stock, they go out in the open market and say, look, we want to get rid of NVIDIA. We think it's gone up too much. So we'll give you our NVIDIA and you give us your Microsoft. And then there's no taxable transaction. You don't pay a tax on that. Now, if that helps the value go up, then you sell it, then it could be more taxable to you because you have more gain. But the internal exchanging of money isn't a problem. Now, this is my little example that's in this book. I'm trying to make sure my son keeps it in there when we redo it. A mutual fund and an exchange traded fund. An exchange traded fund is like you own the shares of the fund on your own. And the mutual fund, you own shares of the fund, but with everybody else. So a mutual fund is like if we all get on a bus and we go up to Lake Tahoe and somebody says, excuse me, I need to use the restroom, you have to stop the bus and let that person off, right? Everybody waits, they get back on, then the bus takes off, right? That's a mutual fund. The exchange traded fund is if we all had miniature little electric cars and we're driving side by side, but you want to go to the restroom, you go to the restroom, we're keeping going to the thing. So that's why Vanguard and everybody else likes exchange traded funds. If you want your money back, you don't have to sell it back to Vanguard. You just sell your shares in the open market and they're out of the picture. They're managing the fund, but they're not having to put you in or out. So that's written about in the book as well.
Would it have been very difficult in the year or the 2 years that fund was down to sell it?
No, it wouldn't, because there's so many people that saw it as a buying opportunity because it's so big and popular, right? But if it wasn't, good question. If it had 8 million, 10 million, 12 million, nobody would buy it. And then you would have to offer a lower price. And then you took what's called a haircut in this business, a huge discount just to get it sold. Same as real estate. If you've got something that's not as popular and it's unusual and it's got a dirt road instead of a this or that, it's hard to get the money turned around. In a bull market in real estate, it sells faster than if things are slow. So that's interesting. So What were we? Oh, we're still looking for what it holds. So, no surprise, NVIDIA, the computer chip, is 10% of the portfolio. Quite big. But they saw it, they went there, and if you bought this 20 years ago, 10 years ago, you're loving it. It's just you've got to get through those dips. And that money needs to be out on the far end of long term. Or this could be 5% of the portfolio just to counteract and not be correlated to everything else. But if you're buying this in a big way, you better be willing to buy more when it drops. This represents technology as a whole. It has 10 pages of positions, so NVIDIA, Microsoft, Apple, same as the S&P 500, but everything else that it owns are all going to be technology. It's not going to start having Home Depot and all these other non-tech funds, I assume. PepsiCo is probably heavily into blockchain or doing something. That would be interesting. So we're at page 3, and I'm still seeing nothing but technology companies or companies that use technology. And the blockchain that is already out there or it's coming is more like a computerized system that's very efficient and all that stuff. The biggest thing about Bitcoin is they have a computer programming system that lets people see a transaction. So if I do business with you, authorized viewers, 100 of them, get to see the same thing. So I can't cheat you because they can all see what's going on. Or I can't say, no, he did this and should have done this. No, that transaction's seen by everyone else. So that's just a real quick view of the blockchain. It will be very good in the long term once we get it situated. So again, this fund did nothing but tech. So if you had a future grandchild, you might buy this fund. I believe in tech. In 20 years, it's going to be great. That's fine. But if you're securing your retirement and you're worried about what if the market tanks or what if I had an emergency financial need, you need this fund in the middle of that dip, you got a problem. So it's not, provided you have legitimate investments that are registered through the SEC and you have advisors or companies that are providing them that follow the laws and the rules, then it's not what you buy, it's how you buy it. It's how you interact with this.
So we've been looking at Morningstar, these two funds. Earlier, we looked at Morningstar, the whole portfolio. If you have the whole portfolio, does Morningstar identify the crossover for all of these different funds? Like,
yeah,
we've got NVIDIA at whatever 10% in QQQ. We've got NVIDIA 6%, and so you can tell the crossover on the whole portfolio.
Yes, that's why I pay nearly $4,000 a year for Morningstar. There's a report I can go on, and it will list all the stocks that are represented among all the funds. So if I've got NVIDIA and it's like, oh my gosh, that's way too big because it's in all these different funds. And that's the problem. When you work with a company like was mentioned, they might have a lot of similar funds that own similar holdings because one manager manages 2 or 3 different of their own funds. We ran into that problem back in the old days with mutual funds. You might have American funds. They're all great. But if the same manager manages 3 different funds, they have very similar redundancy of holdings. So Morningstar has a report, I think it's called the intersection or something, where it will list among all these funds, these are the top stock holdings that you have. And then if it's too much or too little, then you go back and reallocate them. So that's why we start with 10%, 10%, 10%. Then we go back and say, what's your risk tolerance? What's your liquidity needs? What's the dividends? Is this providing much dividend? And what's your political view and everything else? And then there's several pages of Morningstar. I don't even know what all these things mean. They keep coming out with new little features in order to show value to me, so I keep paying for their program. Plus, they have competitors out there. But you could go to Morningstar and get a free app on your phone, a free trial or look at, and get pretty close. And if you want to buy a mutual fund, you can say, what's the Morningstar rating? 1 star to 5 stars is historical performance, but if it's just one of everything, a neutral is fine, and then a gold, silver, bronze is how they run things, the parts. But Morningstar doesn't say this is going to be good in the future. The best way to do that is what part of the economy is down the most for the right reasons. And then if it makes sense to you, you buy. Because sometimes utilities would be down a lot, 20%, so we add to utilities in order to get a pretty good dividend. But when we saw that they were up like 40% recently, we took 25% of the utilities and we bought Vanguard Real Estate Fund that was down 16. And so that fund's come back up. Why was utilities up so much? Because the word got out, AI's big time. Well, what's that got to do with the utilities? We're going to build data centers. What's that got to do with utilities? You need to transfer power between places. It's too late to buy utilities. You know, if you have them, great. I bought them because they were conservative and dividend, or the real estate fund we bought because the price was low. So when you're earning 3% and the price goes down, it makes the dividend look bigger. Now it's 4%. Let's buy some real estate. And guess what? It went up. Why? Because they're going to buy data centers. So you can never really project and predict anything. You can just forget that, get that out of your head. But if it's a good layout for you, then it's a perfect predictor of what you need in the future. And you're going to have to add some of these little bit more volatile funds in there if you need that. Shaniqua, if you need to, we can turn the air down if it's getting chilly. You guys getting cold? Okay. So I'm going to come out of this fund. Well, before I do, though, let's go to risk. Our overall portfolio's risk was, what, 71% of the market. This one, remember that word standard deviation. I think the portfolio as a whole had 11%, was it, volatility? This fund itself has 18.7 compared to the category or the index. So in any given down market, this fund could be down 18.7 on average in the past. So the upside gain is quite good. You saw a year that it was up 53%. So if you were going to take some Reno money, this would have been a good fund in the past. It may still be a good fund. $12 trillion coming to the U.S. I don't know if we peaked out or we're going to triple. We just don't know that. So if you invest the portfolio in time frames, short-term, intermediate, long-term, and allocate it, then you do everything for the right reasons. And if something drops a lot, now you must go back and feed your horse. Give it some money when it's down. If it's up too much, painfully sell off a few shares and put it somewhere that's down. That's a good rebalancing concept. So this fund itself has a lot of volatility there, but the alpha, what that means is how much more has it performed per year, 3.5% per year more than the category or from the index or whatever. Theirs is only up 1%. In the index 2.96. So you're a little better than the index by 0.60 or something. But again, this is a fund that lets us use technology and it comforts the client if they've heard of this fund because they know who the QQQs are, or you see their ads all the time. Now there's other funds out there. Here's something that if you want to balance the portfolio with some bonds, this has treasury bonds in it. And this will give you a pretty good yield, relatively speaking. It says it's only 3.75 or almost 4%. And it only owns short-term treasury bonds. So, and its expense ratio is 0.15. But the yield is almost 4%. And if you don't want to be buying treasury bills on that government website, and I don't want to be doing this and rolling this over, you can buy this fund, and as the T-bills renew, they'll buy new ones. And they'll just keep rolling it over. Now you can get out of this fund and sell it any day you want. And the only threat to the share price would be as if interest rates went up a lot. And we'll see that back here in 2021, 22, when the Fed raised interest rates, this fund dropped a little bit. It looks like a lot because it's a short time frame, but it dropped a little bit up to 5 or 6%. And then when rates stabilize, or people think rates are coming down, the fund value goes up. Another concept we'll talk about a little bit. But. So we'll see in 2022, when this was committed to 3-year treasuries, but now 3-year treasuries coming out are paying more, the fund dropped temporarily by 3.8%. But those treasuries are going to mature, so they're going to get back on their feet and you'll be okay. If this were 30-year treasuries, you would be really disappointed if they dropped in value because you can't sell it. Nobody wants it. If you're getting 2%, new ones are paying 4. But if you bought them at 4 and rates go down to 2, now you're the hero. Somebody wants to buy your bond from you. The 30-year Treasury bonds, I think for the last 10 or 20 years, they're down 40% if you sell them prematurely, right? Because you bought them at 2%, now you can get new ones at 4. Why would somebody pay you what you paid? Okay, but like I say, if you've only got $1 million, you need to live off of $40,000 a year. You buy those treasuries, lock it in for 30 years, and that's not your problem. That's your beneficiary's problem if the resale value goes up or down. Now, to see what's in it is very clear, but we'll just take a look at it. Oh, the risk level is only a 6, conservative, right? Standard deviation over there is only 2%. That's pretty low. Because when you buy a T-bill or a CD, if you cash it in before it matures, the bank might keep your interest or something. But if you were to sell it to another investor, its value, if you bought a CD and interest rates went up before it matures, you would only be able to sell that CD at maybe 99% value, because nobody wants your CD if it's earning 2 when new ones are paying 3. Now, the bank will give you the statement saying it didn't drop in value, but if you cash it out, you might lose either principal or some of the interest. So this is made up of, it has a little bit of volatility because the maturity's there. But the good thing about a fund like this is, if it has 3-year T-bills in it, is that a good thing if interest rates fall? Yes, right? Because your yield will last for another 2-3 years, when if you had a 3-month CD, they drop. So now I'm contrary to what I've been saying for 25 years. It could be a good time to look at a little bit longer term maturity. Not too long unless you're willing to tie the money up, because we don't know with politics and all this other stuff what can happen. This tells you, if you're into this, the upper left-hand corner is high quality limited term bonds. These happen to be corporates. But what I'm going to go down to is get a picture of, and they're all government, right? Government securities there. And there's a picture of all the bonds. I don't know if, yeah, there they are. So it has 10 pages of treasuries, if you want to know. There's one paying 1.2, one paying 4.25. So this is a bucket of treasuries. You can get one that's like 0 to 3 months. We have one that we park money in, and it'll buy treasuries that have 0 to 3 month maturity. So you can sell it anytime you want. You're not going to lose any money on the share price. But as they mature, the yield will start going down. Here, you're going, well, I don't really need this money for a couple of years. You park it there, and I'm hoping rates will fall, because then I've locked in mine a little bit more. But some of these are due to mature any day now, probably. So you're not going to get an absolute wait 3 years, but it's going to hold its yield a little bit better. So that's nice to see what's in that. Since we've talked about the S&P 500, here's something that's going to be familiar. The S&P index, S&P 500 has 500 stocks, and they're all the same allocations based on their size. Vanguard, Fidelity, Schwab all have an S&P 500 fund, because they knew that people would be drawn to that. And they all have to pay the originator of that index copyright. They have to pay them a fraction, tiny little fee of their fund. So this fund should be very similar to Vanguard, Fidelity, or Schwab. Although, if anybody has a lower expense ratio, 0.095 is a little higher than what I think I would see at Vanguard. But why would I use this S&P 500 fund versus Vanguard? Trick question. Because when I do a portfolio, I don't want everything with Vanguard, right? They're the cheapest. If I had to pick anybody, they would be them. If they go in with a blindfold on, it'd be all Vanguard fund. But what if, just what if, they get hacked, right? This quantum technology and all this stuff gets to the point where they hack them, and they can't get you your money right away. It's going to take a month or a week or 2, and we've got to authenticate and reboot and take all our storage and memory and all that stuff and bring it up. Then you can have your money, but you can't have it now, right? Has that ever happened? with banks, insurance companies. 2008, a money market fund actually dropped to 97 cents a share. It was supposed to be $1 because Lehman Brothers folded, right? So I don't want all my eggs with Vanguard, love them, but I'm going to have some with the other companies that I mentioned. Or Invesco because they do something unusual. iShares is actually almost, I think Vanguard might be the biggest, maybe it's iShares, but that's BlackRock and that's their exchange traded funds out there. But you can read in the book, what's an exchange traded fund and why should I do this or that? And like I say, if you can't get enough of this, come back next week, but you can go online and watch all the classes. My son's smarter than I am. He can talk all the details and stuff. But this is kind of interesting. So one, I wouldn't love that it's 0.095. I think I could probably get 0.05 at Vanguard, but I want an S&P 500 fund. I've got other Vanguard funds. I might use it just so I don't have all my eggs with Vanguard. And then I've got some with Fidelity and Schwab and iShares and so on. So as far as that goes, I don't have to worry about being hacked. Your brokerage account downloads all this information, says what you have, but the money's actually held at Vanguard in a trust or a vault type thing. So that's my thing, is massive diversification among fund companies and then among different funds, so they're opposite of each other. And then in the funds, different stocks and bonds. So sure, you may walk in with your head down, oh, the market's terrible, but you're not worried about, am I going to lose it all? Is it going to go bankrupt? That's something we shouldn't have to worry about. That's not right as an investor. If you're a speculator, sure, go for those individual stocks and have bragging rights. But I've never seen anybody do it on a consistent level. And like I say, if they could, there would be no stock market. They would take all our money if they could outdo something. Or what's the movie where he goes back and looks at the book? A gambling book? Oh. He goes back in time with a crazy professor.
Oh, yes.
Yeah, you know what that is.
Yes, I do.
Back to the Future. There you go. Okay. So this is not T-bills. This is one of the funds in the portfolio that rather than buy one stock, we buy this one fund, and we want this different company to house these dollars and be a little different, slightly different. You'll see in a fund that's like this, it's more of an index fund, the turnover is quite low. Buy and sell, it's only 3%. A lot of managed mutual funds might have a 40% turnover, maybe 50. If they're successful, fine. A lot of turnover, you're making money, I'll pay a higher fee. But if there's a lot of turnover and you don't see them going up on the mountain chart, why would I pay a higher fee for that? And the tax hit could occur if it's not a retirement plan. So when we go down a little lower, this is just going to track the S&P 500, and it's not going to tell you what the S&P did. The yellow and the blue line are the same. Category or other funds similar to it. So it's pretty much the same. And this is a fair amount of time. If we go 21 to 20 whatever, a year, 2 or 3, it's kind of scary, maybe all the way out to 23. 2 years of not knowing, is this going to go down or go up?
Why do you say that? I mean, history says it's always gone up.
Yeah.
Just a question of whether it's 2 years.
Exactly.
I just can't.
Well, I totally agree with you long term. I'm not allowed to guarantee anything, but if I did, I would guarantee the market's going to keep going up. Long term, after 7, 10 years. In the short term, we've seen the market tank 12 years in the Depression, 6 to 10 years in 08, and the average is 6 years in a decline. So in and of itself, this fund could drop for 6 or 7 years historically, but you wouldn't be liquidating because you have other options, right? But if I were to gamble on anything, based on all the charts, the stock market's always gone up because what else has gone up over the globe? Inflation, but what else? What has increased, multiplied? Human beings, right? And we're the ones that go buy the products, goods, and services that allow people to make profit. So if I were allowed to guarantee anything, and I'm not, I would say that the stock market's guaranteed to go up. It's just that it might take more than 6 years, 7 or 10 if there was a big crash. So if you have a portfolio with your longer term investments here, then great. Then your only job in this dip is to do what? Add some money to it. And that's great. Or like I say, if you've got retirement money, insurance, everything's guaranteed for 5 or 10 years, then you do more of this. Instead of being 5%, this might be 15% of the portfolio. That's why we allocate it based on your time frame is different, your risk tolerance is different, and all those things. The clients that I have that have made the most money were the ones that says, look, I want mostly stocks. And when the market tanked, I called them, hey, guess what? You're not down quite as much. That's not a problem. It's always been down before. That person over the long term will make the most money, hands down. But somebody driving from the West Coast to the East Coast in a race would drive probably faster if they didn't have seatbelts, airbags, and all these safety measures, right? But if they get in a wreck, they'll be glad they had them. So it all depends on that person's situation. And that's why we don't prefer advisors that just plug in, send the money to the home office, and the home office invests it. The home office doesn't know anything about the client. Well, what's your risk tolerance? Well, I don't know. You know, it could be really good or bad. And then also, we'll talk about later, you need to reevaluate every year. I check with my clients. We have a formal meeting on the phone or in person every single year. That's why I have this office here. My Grass Valley clients, I can meet here. But we need to do this on a regular, ongoing basis, yearly for the annual meeting, but check in throughout the year to see, are you still okay with this? Because your life may have changed. If you, like I did at 70, hey, I got Social Security now and it's a lot of money. That's the equivalent of $500,000 bond or $1 million bond or something like that. Then you say, look, I'm not stressed out at all now. My pension started, I got Social Security. This money's for the kids. Well, then now it needs to be invested for a younger age and a better time frame at that point. So everything is pretty much relative to everything else. And have I gone over time? Sorry. Okay, so I've gone over time. We whet your appetite with this stuff and look through the book, flip through it quickly or not. We do explain what all the parameters are if you want to look at them, if you want to look at the website, but by all means, come back with anybody. We're going to try to make this work quarterly. We want to make this the Wealth Strategies Academy so we can teach people. We're happy to teach other advisors if there's any out there, if we can get them to come. But a lot of their home office wouldn't like that, though, because then they start realizing, wait a minute, my company's not letting me do this for the client. I have to do what they tell me to do. That's a problem. So, but it was fun. Thanks for coming. Come back next week. Drag somebody else with you if you want to, but we're going to do it because we modeled this as like a cafe class session, so it'll be fun. Any questions?
Is it a good idea to change IRA to a Roth IRA?
Excellent question, and I'll answer that, and then you can go. There's a section on the book that you can look at that, why you should or why you shouldn't. If you're going to be in the same tax bracket going forward, and or lower taxes, some people are in a lower tax bracket now, then it is a good time. For example, because we promised to talk about taxes, one of the big things is, yes, if you don't make $75,000 or $150,000 in a couple, if you make that much or less, you're going to get that Social Security credit, $6,000 tax deduction. That's nice, right? Plus, if you pay a lot in property taxes and state taxes, if you itemize, you're going to get to write off a lot more, up to $40,000. So if your taxes are the same or lower in the future, it's not a bad idea to start converting a little bit or a lot, depending on how much tax you want, because the more that you convert, the more you get out of your taxable IRA or 401k, which is going to grow and be more of a liability down the road. But don't do anything without running some kind of tax estimate. See your accountant or whatever and make sure it's not a big mistake. But because of those two areas of the tax reductions, plus if you do itemize, you get a higher itemized deduction. And you also get to use the $6,000 or $12,000 Social Security tax credit. If you itemize, you don't get to use the SALT tax because you're not using, you just itemize. So take a look at that. But yes, converting from an IRA to a Roth would be good if it doesn't trigger higher cost of Medicare, right? That can make your Medicare go up. So you want to be careful with that. Have an accountant say, look, I'm going to do this. What's the ramifications? Medicare is going to go up for 2 years, but if it's not that much, and I get money out of the IRA into the Roth so you pay a little less taxes later, and or you can leave that Roth to your beneficiaries tax-free if you're wanting to help them. But if your income is going up a lot in the future because you're now a consultant and you're making a lot of money and you thought you were going to retire, I wouldn't be converting it in a high tax year.
And with RMD, you don't, there's too many moving parts to that
Right.
scenario.
Yeah.
It's like,
Yeah, if RMD is a big problem, and if this happened to be a low tax year, do the conversion because it'll reduce your future RMDs. You won't have as much money there. But it's a moving target. You got to make sure you pick the right one. And if you have somebody do your taxes, just tell them, I want to, maybe do a Roth conversion. Is this a good year? Generically, it is if you have the $6,000 tax credit and you use the SALT from 10, state and local tax thing from 10 to 40, and if your income is the same or slightly lower, and if you've reallocated your portfolios in tax efficient models, because if you have a non-retirement plan and portfolio model and you have a tax problem, then the bonds should be municipal bonds, and most of the funds should be index funds that don't have a high turnover, and most of them should be exchange traded funds that doesn't trigger taxes. There's a whole nother level there that you or your family member or your advisor should be looking at. So help us grow this class. Come back next week. Pretty cool.